All right, so, keeping an eye on the markets lately. Things have been, well, a little shaky, haven't they?
Yeah, no doubt. Plenty of ups and downs, especially with tech, like that dip we saw in the Nasdaq Q.
That's what we're zeroing in on today. See,
Right.
for investors, sometimes the downturn, it can actually be a chance to, well, spot some real potential.
Absolutely. I mean, when the tide goes out, right, you get to see who's been swimming naked, as they say.
Right. So we're diving deep into two AI stocks in particular, ARM Holdings and Upstart Holdings. They've both taken a bit of a hit price-wise.
Yeah, they've seen some pullback for sure. But what's interesting is there's this sense from Wall Street that they might be worth a second look. Like maybe this is a buying opportunity.
That's the big question, isn't it? That's what we're going to unpack today. We're going to dig into why some analysts are feeling bullish on these two, even with those drops. And we'll be drawing from some recent analysis from the Motley Fool for this deep dive.
Good stuff. Always like their insights.
So for everyone listening, here's the plan. We're not just going to focus on the stock prices. We're going deeper, right? We want to understand these companies, like what's at the heart of their business? What's got these analysts thinking they could rebound? And what should you as an investor be thinking about if you're even considering them?
Exactly. No need to get lost in the weeds, but we'll give you those key points to consider.
Right. So let's kick things off with ARM Holdings. They've had a pretty noticeable correction recently.
Oh, yeah, for sure. Their stock's down, about 33% from its highs earlier this year? Seems like part of it's tied to, well, their recent guidance. Not quite as rosy as some folks were hoping for.
Okay, so a dip to be aware of. But here's the thing, right? Despite that, the analysts following ARM, overall, they're pretty optimistic. Their median price target, $177 a share. Now, last time I checked, end of March 2025, the stock was around, $125?
Yeah, right around there.
So that implies a potential upside of something like 42%. Not bad at all. And this isn't just a couple of analysts being super hopeful either. That median target, it's based on projections from 41 different experts.
That's a pretty sizable group. Suggests there's a reason for that optimism, wouldn't you say?
Definitely something to consider.
Yeah.
So let's get into, the nitty-gritty. What does ARM Holdings actually do? What's the core of their business?
So this is where it gets interesting. They're not actually directly making and selling chips themselves, at least not as their main gig.
Okay, so what are they doing then?
Their real value is in their designs. They create these incredibly power-efficient CPU architectures, the brains of a computer, and all sorts of crucial subsystems within a chip. Then they license this IP, these blueprints, to other companies who actually handle the manufacturing.
Kind of the architects of the computing world.
Exactly. They provide the designs, the know-how, the tools for others to build upon. And they've also got this whole suite of software development tools so engineers can create applications that run on their processors. They're at the foundation of a huge ecosystem.
Okay, so they've got a big footprint.
Yeah.
And they've historically been super dominant in a specific area, haven't they?
Oh, yeah. You think about smartphones, ARM is basically the go-to for power efficiency. And that's crucial for mobile, right? You don't want your phone dying after 2 hours. That's largely because of ARM designs.
So how much of this smartphone market do they actually have?
It's kind of wild. Over 99% market share in smartphones and a hefty 67% in other mobile devices. It's almost a monopoly, which, gives them a solid base.
That's pretty impressive. But it seems like the game's changing a bit, right? Not just about our phones anymore.
You got it. They're making moves in areas that were traditionally, dominated by different chip architectures, like take personal computers, PCs. We're seeing ARM gain real traction there.
Any big examples of that?
Well, the most high-profile one, got to be Apple, their whole MacBook line. Now running on their own custom ARM-based chips, the Apple Silicon.
Ah, yeah, heard about that. Big shift.
Huge. And even bigger, maybe, is their move into data centers. The big cloud providers, Amazon, Microsoft, Alphabet, they're all using more and more ARM-based processors in their server farms.
And those are handling some serious workloads, right? Especially with all the AI stuff going on.
Exactly. Not just general computing tasks, but AI, which is super demanding on processing power. And that's where ARM's efficiency really shines.
All right, got to keep those energy costs and heat down in those giant data centers.
You got it. That demand for efficiency, it's a massive tailwind for ARM. And it shows in their recent performance, too. Third quarter of their fiscal year 2025, which ended December 2024, they had a revenue jump of 19%, hit $983 million.
Not bad at all.
Nope. And their non-GAAP net income, which basically gives you a clearer picture of ongoing profitability, it was up 26%, reached 39 cents per diluted share. And they specifically said this growth was fueled by, you guessed it, AI.
Okay, so they're doing well, riding the AI wave, but then why the stock dip? It doesn't really add up.
It's about expectations, right? The market's always looking ahead. So yeah, the results were strong, but they also narrowed their full-year guidance a bit, projecting a revenue increase of about 23% now and net income up around 26%. Still good growth, but...
But not as good as some folks were betting on.
Exactly. And sometimes even a slight slowdown in growth rate, it can spook investors a little.
Makes sense. So how about the valuation? What does ARM stand right now in terms of how the market's valuing them?
Well, currently they're trading at about 85 times their adjusted earnings. And even though Wall Street's estimating they'll see like a 31% annual earnings growth through fiscal year 2026, which ends March next year, that valuation, it can seem pretty steep.
Like maybe a lot of future growth is already baked into the price.
That's one way to look at it. So for our listeners, the key takeaway with ARM is this. You've got this long-term potential. They're a leader in energy-efficient computing. They're gaining ground in data centers. They're benefiting from the AI boom. But you got to weigh that against that premium valuation.
Like a fancy restaurant with amazing reviews, but, a hefty price tag. You got to be really sure it's worth it.
Exactly. The analyst in the article we looked at, they seem a bit skeptical that 42% return will happen in just a year. But they suggest if you're patient, if you believe in ARM's long game, maybe starting a small position makes sense. It's a long-term play.
Makes sense. All right, let's switch gears now. Time to talk about our second company, Upstart Holdings. Now, their stock decline, that's been even more dramatic.
Oh, yeah. No kidding. We're talking an 86% drop from their peak back in 2021. And a lot of that, you can chalk it up to, well, the whole economic roller coaster we've been on. Inflation going crazy, interest rates shooting up. It's a tough environment for lending, period.
Makes sense. Borrowing gets more expensive, people hesitate to take out loans, the whole thing slows down. But even with this massive drop, some analysts are still seeing potential. What's the story there?
So we've got 17 analysts covering Upstart, and their median price target is $86.50. Now, as of late March 2025, the stock was around $55. So that's a potential upside of, get this, 57%.
Wow. So again, a big gap between current price and those analyst expectations. What is it about Upstart that's got them feeling hopeful?
Let's break it down. Upstart, they're in the fintech space, financial technology, specifically lending. Their core offering is this AI-powered platform that banks and credit unions can use to assess credit risk. They've got over 100 partners already, covering stuff like personal loans, auto loans, refinancing, even home equity lines of credit.
AI for loans, huh? That's got to be different from how banks usually do things.
That's the whole point. Traditional lending models, they're often pretty basic rule-based systems. They look at a handful of things, your credit score, your income history, not much else.
Right. Pretty standard stuff.
But Upstart, they're using machine learning. Their models analyze thousands of data points for each applicant. It's way more granular, way more nuanced. They say it gives a more accurate picture of someone's actual creditworthiness.
So instead of a simple checklist, it's like a super detailed risk profile.
You got it.
Got it.
And they claim this has some big benefits, both for borrowers and lenders.
Like what?
Well, for banks, they can potentially approve more loans to people who might have been denied by those old school models. It opens up credit access for more folks. And because the risk assessment is supposedly better, they can maybe offer lower interest rates too.
Makes sense.
Plus, it streamlines things for the banks. A lot of the loan process can be automated, less manual work, faster approvals. Everyone wins, in theory.
Okay, so that's the pitch. But how are they actually performing? Are they walking the walk?
Well, their fourth quarter results were pretty impressive, actually. Beat expectations. They saw a 56% jump in revenue, hit $219 million. And that was mainly because of a big surge in loan volume through their platform. Plus, their non-GAAP net income swung to a positive 0.29 cents per share compared to a loss the year before.
That's a nice turnaround.
Yeah, and they're projecting 56% revenue growth for all of 2025. So they're definitely seeing some momentum.
That's a solid. So how big is the market they're playing in? Is there room to grow?
Huge room. They estimate their total addressable market for loan originations is over $2 trillion annually. But in 2024, they only did about $6 billion in transaction volume. They're just scratching the surface.
Wow, that's a massive difference. So despite the past stock troubles, the growth potential is definitely there. How about valuation, though? Where do they stand right now?
Currently, their price-to-sales ratio is about 7.8. Interestingly, that's actually lower than their historical average of 9, so it might not be as overvalued as some people think, especially considering that projected 56% revenue growth.
So for our listeners, what's the bottom line on Upstart? according to the analysis.
Well, it's kind of like ARM. The analysts, they're not totally convinced about that 57% return in a year. But if you're looking at, say, a 3-year horizon and you can handle some economic bumps along the way, maybe a small speculative position makes sense. The potential for disruption in lending using AI like they are, it's definitely a compelling story.
But there's a big caveat here, right? Something that really hammered Upstart's stock back in 2021.
Absolutely. They're super sensitive to the overall economy. Inflation goes up, interest rates follow, people borrow less, defaults might rise. It all hits Upstart hard. That's exactly what happened post-COVID. Inflation spiked, rates climbed rapidly, their stock plummeted. That risk is still a major factor for any investor to consider.
Right. Got to factor that in. So we've covered a lot of ground here. Big picture, what should our listeners be taking away from all this, looking at ARM and Upstart?
The main takeaway is, yeah, this Nasdaq Q correction, it might have created some opportunities in these AI-related companies. But it's not a slam dunk. These are not sure things. You got to be careful, do your own research, understand the risks.
We've seen how ARM is all about that energy-efficient computing, expanding into data centers, riding that AI wave. But they've also got a high valuation right now. And then Upstart, they're trying to shake up lending with their AI models, showing strong growth, but also vulnerable to those economic shifts.
Exactly. And keep in mind, what we've done here is give you a condensed version of what these analysts are saying. We've highlighted their main points, their focus on growth potential, on current valuation, and on the risks involved.
So as we wrap up, here's something to think about. AI, it's changing everything so fast. And the global economy, it's always unpredictable. What other surprises, good or bad, might pop up for these companies? For tech as a whole? For finance?
Great question. It's an exciting time, but a wild ride. Got to stay informed, stay critical.
Couldn't agree more.
Well, this was fun.
Always is. We'll be back next week, same time, for another deep dive into the world of investing. See you then.